Hello, this is Chuck Carnevale, co-founder of FastGraph. And with this Part 3 Analyze Out Loud video examining the Dow Jones Industrial Average, I'm going to look at 6 of probably my most favorite stocks in the Dow Jones. There are 3 or 4 others I also like a lot, but these would be 6 of my favorites. I have these stocks listed in order of highest credit rating to lowest, and you can see they are all high-quality investment-grade stock. And of course, household names: Johnson & Johnson, Apple, Wal-Mart, Walt Disney, UnitedHealth Group, and United Technologies. With my first example, I'm going to look at Walt Disney Company. And for those viewers who are not totally familiar with fast graphs, I'm going to use this first graph as an opportunity to build a fast graph and show you what it offers. This is the company's profits per share at 15 times earnings. So the orange line is a 15 PE ratio. And what you see here is that Walt Disney has basically grown their earnings very nicely over this time frame. Consistent earnings growth is an attribute that attracts me to companies. I like companies that have good proven track records. And even when they're not growing, they stay highly profitable. Of course, Disney foots that bill. So when I show you subsequent examples here, I do want you to focus on the growth and the consistency of the growth of the orange line on each of these companies. The next thing I'm going to add here are the dividends and the dividend payout ratio. This is a plotting of each year's dividends, the white line, and this area below the white line represents the portion of earnings that the company pays out to shareholders. So these are what the dividends look like while the company still held them, if you will. And then the next thing we do is we take those dividends and we stack them on top of the orange line to illustrate that this is after they've been paid out of the corporation, and this is where they now belong to the actual shareholders of the company. And then next I'm going to add monthly closing stock prices, finally bring them into the equation, if you will. And there's something I really would like you to kind of think about as I go through all these examples. Notice the effects of overvaluation. When I say a stock is overvalued, that doesn't necessarily imply that you can't make money buying the stock, but it does probably mean that you ought to be careful, because an overvalued stock can be a long-term underperformer. And if you look at what Disney was trading at these monstrous PE ratios back in 2000, and there were several years here of really poor price performance, even though the company's operating performance wasn't that bad. And then, of course, you can also see that when the price is at or below the orange line, those turned out to be optimum times to invest in the stock. And then finally, I bring in the normal PE ratio, and this is another valuation reference. Now I've got 2 valuation references on the graph. In this case, at this iteration, I've got a 21.6 normal over this long time frame, and I've got a fair value reference of 15. And so I can look and know that this is above 15 but below the 21.6, etc. But this allows me to really look at what's been normal for the stock. Now, as I change time frames, I'm going to knock about 5 years off of this graph. I get a slightly different calculation. I have a different growth rate. I still have the 15 PE, but now I've got a 17 PE. And this graph tells me that, you know, as long as I was buying Walt Disney at something between 15 and 17 times earnings, it was probably an attractive purchase. So in this case, based on that thesis, it was pretty close to being fair valued at the beginning here, Disney was. And had you bought the stock there at fair value, and it's just about, you know, a slightly lower PE ratio now, you'd have made approximately 13% annualized rate of return. You'd have tripled your money, basically. And the reality of it is, that's pretty close to the 12.5% growth rate that the company was generating over this time. So, you know, valuation can hurt you, of course, if you overpay for the stock. You know, you can go through a 2-year period here where you're down 12%, and what's happened is the stock is now back to fair value. But the bottom line on Disney is, by looking at this graph, you can see that I consider it fully valued but not overvalued. Now that I've kind of oriented y'all to what fast graphs is illustrating, I'm going to go ahead and go through these examples with fully built fast graphs, looking at adjusted operating earnings on each of these examples, so that you can see what really happens with overvaluation or fair valuation. And here's a case of Johnson & Johnson. We have very consistent earnings growth. The market has applied a high PE, or that it calculates, but that's because how overvalued Johnson & Johnson was back in the 2000, 2001, and 2 period. And of course, that led to headwinds for price movement. But then when the stock got reasonably valued, you can see what a good performer it's been. And it is moderately overvalued based on earnings and moderately undervalued based on a long-term normal PE of about 20. But let's go ahead and chop some time off of that, and we see now that for this more recent history, a 15-ish PE ratio has been more relevant. So I would consider Johnson & Johnson moderately overvalued here, but not to the point where I would sell this AAA rated blue chip. Clearly, the best time to invest in Johnson & Johnson is when its price is at or below this fair valuation of about 15 times earnings. With my next example, I'm going to look at UnitedHealth Group Incorporated, and once again, you see this very consistent earnings growth. You see a dividend, but a very low payout ratio here in these earlier years. And then, of course, you see the company began to increase its dividend payout ratio in about 2011 to where it's currently paying out about 25 to 30% of their profits, but they had very, very low payout ratios, obviously, prior to that. As I shorten this particular graph, watch the growth rate. It goes from 18% to 13%. And then I drop it to 10 years, and it goes from 13 to 14. So that's kind of a range of growth. And this would indicate that UnitedHealth Group is moderately overvalued as well. Again, not to the point where I would sell if I owned it, but I certainly wouldn't be too excited about purchasing UnitedHealthcare at these levels. My next example is United Technologies, and I really like this particular one because you really get to see a real high correlation between price and earnings over the long run. But you also see a nice range of valuation here. The orange line is a PE of 15, the blue line is a PE of 17, and you can see that, you know, on the upper end of, let's say, the valuation range, full valuation, you could buy this stock at 17 times earnings and do real well as long as you held it long enough. And of course, you also would have had ample opportunities to buy it at a 15 PE, where you would have even done better. But regardless, you really get to see an excellent picture of valuation. And since it's so close to touching the blue line here, I would consider United Technology fully valued, fairly valued. You know, it's not cheap, it's not expensive. With my next example, we look at Wal-Mart. And I really truly believe Wal-Mart is one of the greatest lessons on valuation I've ever seen. Ignore the numbers here. This blue line is calculated so high because you had all these high valuations here. But I'm going to take it off the graph here for a moment so you can see this more clearly. Here's a clear case where PE ratios got, you know, higher and higher up into the 40s, you know, all the way up at the very peak here into the PEs of 50. And this was a time when Walmart's earnings were growing very nicely. Right at the bottom of the graph here, you can see they were growing by 19, 24, 29, 9, 6 coming into the recession, then 21, 12. These were really excellent operating results. But you also notice that there was absolutely no gain in Walmart's stock price during this period of time. And to me, that's a classic example of what overvaluation can do to your returns. You know, I'm just going to pick a spot here and bring it back to fair valuation. And that would have been a, you know, 5, 6, 7 year period of time where you were down 20% in your investment, averaging a 1.8% annualized loss. And it had absolutely nothing to do with Walmart at that point. It was all about how the market was valuing their stock way too aggressively during that time. Then, of course, you've seen a nice correlation here. Walmart's gone through some changes, I think reactions to Amazon, etc. So they've had a little bit of stress in their earnings recently, but the company's still massively profitable. And I would consider it moderately overvalued at these levels. Again, I don't know that I would sell Walmart if I owned it, but I wouldn't be a buyer right here at these levels either. And then with my final example here, we're going to take a look at Apple. And Apple's had such incredible rates of growth back here in this period from like 05 to 2013 or so that I'm going to go ahead and draw this one logarithmically, because there's a couple of things about Apple that I think are really important. And I just recently did an article in a more comprehensive video than this, but I want you to notice that when you look at Apple's earnings growth, you see this period of very high growth and high stock performance. And if I calculate that growth, I got to get to where I can calculate it. You can see that Apple was growing like at 41% a year from 05 to current on average. But you can also see that the growth rates have begun to slow down here in more recent years. So I dropped this as a 10-year graph. And now Apple has grown about 18%. And this includes estimate data, so these aren't history. Now Apple's growing around 11%. But what I really want you to see here, and I'm going to take the logarithmic scale off, is the fact that the market has been applying a discounted PE ratio, normal PE ratio to Apple here in recent years. On this longer term graph, you can see even though they were growing at 25%, the market was valuing this about at a peak of about 17 drop it down to 9, and the market has been valuing it more in line with this 15 PE. Moderate overvaluation, but nothing dangerous. Anyway, this has been Chuck Carnevale saying thanks for listening. I hope you enjoyed it.